Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. This is the second in a series that looks at earnings quality when it comes to selecting the right stocks to invest in. We're in a United States context. We're not looking at this moment at stocks around the world. We've spent a lot of time looking at international investing, but now we're zeroing in on the United States. We're looking at a wide universe of stocks. We're not just talking about the household names that people talk about all the time. We're talking about the thousands of stocks that you can invest in the United States. So we're talking about large cap and also SMID. What's SMID? Well, it's one of those nicknames they use on Wall Street. It just means small and mid cap. Okay, what's small and mid cap? Well, that just means little companies and medium-sized companies. So this is large and small and middle-sized companies that we're looking at. So it's a broad array. Generally, the best return of the year, the best return of the day isn't one of your celebrity companies. Yes, we all know the stories of the Facebook and Amazon and Apple and Netflix and Google and Microsoft and all the rest of them. They're well known because they're big, but that doesn't mean they're the best performers. There's lots of good performers every year that you've never heard of, and that's why it's worth looking at the whole universe of stocks rather than just the ones that get above the fold coverage in the news. All right, let's look at some data. We're looking at earnings quality. This particular one is cash flow over assets. Last time we looked at gross profits over assets. Why look at cash flows? Because it's easier to lie about profits than it is about cash flows. When you're calculating profit and you're making certain expenses that you are deducting, you're calculating certain expenses to deduct, there are judgment calls about that. How long do you think this piece of equipment will last? So how much of a write-off can you take on it in the first year? So there are all sorts of little things that are discretionary items that the CFO of a company can kind of, the financial technical term is shenanigans, can engage in shenanigans. It's a lot harder to do shenanigans with cash flow. You got to pretty much outright lie. Either the cash came in or it didn't. Either the check came in and cleared or it didn't. So cash flow is very difficult to lie about. So you're taking out a little bit of the discretion when it comes, and maybe it's not even lying. Maybe it's just what's called earnings management, just kind of shading things a little within the law, but not really telling you in a completely truthful way or the most accurate way what's been going on. All right, so we took the countries that have the best cash flow over assets. So that is how good is this particular company at taking the assets that it owns, which it bought. It buys assets, property, plant, equipment, patents, whatever it bought. It bought something, and then using that something, it creates positive cash flows. More money in the door than going out the door. So how good is it at turning those assets into cash flow? Another way of saying that really is how good is it at choosing the right assets to invest in, which will give it the cash flow? Those are really two ways of saying the same thing. And based on how good it has been, we take all over the history of the data we have and we say, we're putting this in a bucket, in each time period, the best 1/5. That's what quintile means. So these are better than the other 80% of American companies when it comes to generating cash flows using assets. And then there's going to be a second best and a third best and a fourth best and a worst. And then the height of the bucket is the average return the next year when you've invested in those companies. So this is inside the company. This is something that the internal accountant is dealing with. This is their own internal decision about what kind of assets to invest in. This is what happens to you as the owner when you invest in that company. And it seems like what happens to you as an owner is pretty good if you choose the ones that have the highest cash flow over assets. Let's keep going. Let's go for second best. Pretty significant drop off. Third best, another significant drop off. This is middle of the pack. These are the mediocres. Second worst, somewhat of a drop off, and pretty big drop off for the worst. So the difference between investing in the best and investing in the worst when it comes to cash flow over assets, which is a measure of the quality of earnings, which measures what? How well the managers do at turning the assets that they buy to operate their company into cash flows, which ultimately they can share with you as dividend checks or stock buybacks. Well, it's the difference between this and this. Or you can average these two together. I like to do that. average these two together and see that difference. So the bottom line is cash is king. This works better than gross profits over assets. And I would suggest one of the reasons is because it takes away more of the ability of these companies to engage in manage earnings, to kind of pull the wool over your eyes, to gild the lily, to engage in shenanigans, however you want to put it. They might want to make things look better than they really are to keep you off their back as an investor for another quarter. Well, it's tougher to do that with cash flow. And if you use cash flow over assets as a metric, you get significant performance advantage in the past. The future is the future, unknown to humanity. But in the past, this has been performative and this has added to performance in significant ways. So we're going to look at another quality metric next to help you understand how to be a better and better investor in this particular case when it comes to choosing stocks to invest in. And that's why you're watching the Eagle Investing Network. I'm Jerry Bowyer. Make sure to subscribe. Thanks for joining us.